we'll proceed. So on to division 2. Why does liquidity matter? So the first thing you must understand when we're talking about buying and selling volume, there is always equal buying and selling volume. There's never more buyers than there are sellers. There's never more buying volume than there is selling volume. Never. That's never a scenario. It's impossible. There's a law. It's like a law. If I sell you an apple, I sold one apple, you bought one apple. I can't sell an apple if you don't buy the apple. Okay? The only thing that changes is the price that it was sold for. That's the only dynamic thing that may indicate on who was being more aggressive. But there is always equal buying as there is selling at the current price. Okay? That is always parallel. It's always exactly equal to the cent. Because I can't sell you an apple if you're not going to buy it. Okay? That's impossible. So now, why does this matter? Why are we even talking about this? Well, the reason we need to talk about this is because you must understand, whenever you execute a position, there's somebody on the other end of that position. Whenever you make $100, somebody loses $100. Not necessarily one person, but maybe collectively a few people. Or that's a part of somebody's bigger position. Either way, when you make $100, someone or a group of people lost $100. So when you take that money from the markets, and when you lose $100, you give that money to the markets, somebody else is receiving that money. Okay? You must understand there's two ends to every single deal, to every single transaction. This means that if you want to enter a position, somebody is entering the opposite position. Now, why does this matter? Well, if you're a smaller player, then you don't really need to consider it so much, because if you want to enter a position as a regular average retail trader, then it doesn't matter so much. Because if I want to go long with $100, say, there's always going to be someone on the other end at this price that wants to go short with $100. There's always going to be someone to match me, to facilitate my trade. But if I am a very wealthy player, if I'm a billionaire and I want to put down $1 billion, I need to find someone else who's willing to put down $1 billion at that price, at that time. And often that is a very complicated task to do with such amounts of money. And this is why liquidity matters, because these larger players need to find people who they can pair their orders with. Otherwise, they cannot fill their orders, and this is why they need to accumulate the orders through large periods of time. So, if they intend on accumulating $1 trillion position, on the euro dollar, they could probably do that within a few days on the euro dollar, because there's over $1 trillion volume per day. But if they want to do it on something like Bitcoin, then that might take them much longer than that. This is why liquidity matters. It doesn't matter to us, but it matters to the bigger players who manipulate these markets. Now, we're going to get into that in the next division, so I'm going to talk about that then.